If you work for yourself, you don't just pay income tax. A 15.3% self-employment tax aggressively attacks your profit before the income tax calculation even begins. To neutralize that penalty, you need a highly specific defense. We are going to build your custom 2026 deduction map step by step to legally shield your income. The 2026 tax code carries two critical tools for this: the restoration of 100% bonus depreciation and a permanent 20% deduction on qualified business income. To use these rules, you must be earning 1099 income. Freelancers, gig workers, LLC owners, and sole proprietors all qualify. If you were strictly a W-2 employee, these deductions are unavailable to you. We will test this map against a realistic baseline, an independent consultant who clears exactly $80,000 in net profit. Applying the updated tax code to a tangible income number turns tax season into a controllable mathematical formula. Let's run the numbers. Step 1. We start by lowering your initial taxable business income directly on Schedule C. This diagram highlights your two foundational physical deductions: the home office on line 30 and your vehicle in Section 4. Zooming in on line 30, the simplified home office method allows you to deduct $5 per square foot of dedicated workspace. For a 150 square foot office, that calculates out to a clean $750 deduction without tracking utility bills. Shifting up to Section 4, the 2026 standard mileage rate is 72.5 cents per mile. Logging 5,000 business miles generates a $3,625 deduction. That single rate covers gas, insurance, and wear and tear. Those miles must be strictly for business, driving to client meetings or picking up supplies. Driving from your house to a primary office space is classified as commuting, and commuting is never deductible. Capturing these physical expenses on Schedule C reduces your gross profit early in the process, before those numbers migrate over to your main tax return. Step 2. We move to Schedule 1. This graphic highlights lines 15, 16, and 17, which house your above-the-line deductions. These are designed to systematically lower your adjusted gross income. Look at line 15. The IRS recognizes that you pay both halves of your Social Security and Medicare taxes, so they allow you to deduct the employer half. On our $80,000 baseline, that places a $5,652 deduction directly onto the board. Moving down to line 17, if you pay for your own medical coverage, 100% of your premiums are deductible. We will input $6,000 here to cover a standard individual plan. Finally, on line 16, a SEP IRA lets you contribute up to 25% of your net self-employment income, maxing out at $70,000 for 2026. A $15,000 contribution into this account secures a massive tax shield. Above-the-line deductions provide the highest leverage available. By utilizing them, you wipe out large chunks of your tax liability while simultaneously funding your personal health and future retirement. Step 3 is calculating the permanent qualified business income deduction. This diagram shows Form 8995, along with the 2026 phase-out warning limit of $201,775 for single filers. To find your qualified business income, order of operations matters. You must first subtract the Schedule 1 deductions, self-employment tax, health insurance, and retirement contributions, from your initial net profit. Once you establish that adjusted business income, multiply it by 20%. Running our baseline scenario yields an $11,270 deduction. This UI mockup of the 2026 Form 1040 shows exactly where that number goes. The total from Form 8995 flows straight over to line 13A on your main tax return. This deduction sits on top of all other strategies, regardless of whether you itemize or take the standard deduction. It functions as a free 20% discount on your taxable business income. This map only survives an audit if you avoid 3 specific failure points. First, the home office deduction cannot be used to push your business into a loss. If your business profit is less than the deduction, the excess carries forward to the following year. Second, if you or your spouse are eligible for an employer-sponsored health plan, even if you choose not to enroll in it, you lose the right to claim the self-employed health insurance deduction entirely. Third, estimating your mileage from memory at year-end fails upon IRS inspection. You must maintain a contemporaneous log recording the dates, exact mileage, and specific business purpose as the driving happens. When you document these expenses properly and sequence them through our 3 steps, the math accumulates. For an $80,000 earner, this combined map legally shields $42,297 from taxation. Executing these forms protects tens of thousands of dollars of your own money. To shield even more, you have to upgrade your legal business structure. As always, this is educational content only. Work with a qualified CPA to apply these numbers to your specific situation.